They don't collapse. They just stop working. Prices don't drop. They don't go up. They vanish. Under normal conditions, markets feel nearly automatic. At any moment, buyers and sellers interact. Orders constantly enter the system. Trades get executed. And from those trades, a price is set. This process gives assets their value. Not opinions, not estimates, actual transactions. As long as trades occur, the system works. But for that system to work, something else is needed: liquidity. Liquidity allows trades to happen quickly. It means that if someone wants to sell, there is someone ready to buy. It keeps prices moving smoothly. Most of the time, it feels unlimited. But liquidity is not guaranteed. It relies entirely on participation. When uncertainty rises, behavior changes. Traders become cautious. They reduce their exposure. Some step away completely. At first, nothing breaks. The market continues to function. But something subtle begins to shift. Prices stop matching. The gap between buyers and sellers widens. What someone is willing to pay and what someone is willing to accept moves further apart. Fewer trades happen, not because the system is shut down, but because agreement fades. As that gap grows, the market becomes harder to use. You can still see prices, you can still place orders, but executing a trade becomes uncertain. Then suddenly, something changes. Buyers start to vanish. Orders that were there moments ago disappear. Sellers remain, trying to exit positions, but there is no one on the other side. And this is where the system shifts entirely. Because without trades, there is no price. The number on the screen doesn't update, not because the asset is stable, but because no transaction is taking place. That number is no longer information, it's just the last moment the market worked. From then on, everything becomes unclear. Some assets fall quickly, others don't move at all, not because they are safe, but because no one wants to trade them. The system hasn't crashed, it has lost its ability to measure value. This isn't just a theory, it has already happened. In 2008, entire credit markets froze. Banks stopped lending to each other. Financial assets could not be priced, not because they had no value, but because no one could agree on what that value was. Years later, in March 2020, a similar situation began to appear. Even the U.S. Treasury market, one of the most liquid markets in the world, started to show signs of stress. Spreads widened, liquidity thinned, and for a brief moment, the system hesitated. What causes this isn't a single failure, it's the structure of the system itself. The participants that provide liquidity, market makers, institutions, algorithms, are not required to stay. When risk increases, they pull back. Individually, that makes sense, but together, it creates a vacuum. Liquidity doesn't decline gradually, it disappears. Each participant withdraws for understandable reasons, but collectively, they take away what the system depends on. Without that support, everything else starts to fail. Because in the end, markets don't run on assets, they run on participation. And when participation vanishes, so does price. We often think that markets fail when prices collapse, but sometimes the real failure happens earlier, when price itself stops existing. And if modern markets rely entirely on constant liquidity, what happens when no one is willing to provide it?